Now, Udit, Sheth, Joint Managing Director at Setco Automotive, is with us on the show to talk about the growth triggers for OEMs, the new product sales, as well as the enhanced demand that's expected for the sector and the company as a whole. Thank you for taking time out and being with us. To begin with, we've seen the MHCV segment rise the most among the autos in the recent past. Udit, with the fact that the sector is now set for further acceleration, what kind of opportunity do you see? Do you think that we can see a proportionate jump in your CV component sales as well?
So, thanks for having me on the show. We've really been waiting almost 9 to 10 months for this to happen. As you're aware, the emission changes, the demonetization, the GST had a massive effect on the inventory management, and therefore there was an industry slowdown. And normally the first half of the year, which is pre-Diwali, we normally have a slow first half in the component sector. Now with a good monsoon, with the new infrastructure coming in, the new roads, which are about 40,000 kilometers of them with more than 2 lakh rupee crore of investment coming in, we see a good upcycle for the next 3 to 4 years. And we are completely gearing up as an organization for that. I think in an engineering sector like ours, auto component sector, once you get past the break even, the volume game is what's going to bring in the rest of the EBITDA margins. Also, a lot of our new products have come on stream. We've started supply into the components sector for the clutches for farm equipment. We're also doing the same for our exports. North America product sales have started. These were things that we were looking to do 9 months ago, which we are doing now. So I think whatever we promised, we are on schedule, and our subsidiary, wholly owned subsidiary, which is our foundry unit, which is our casting unit, fully integrated with a machine shop, is also taken off. We are going to break even at the end of the quarter. We are looking to make a small profit by the end of the financial year. So that's a lot of improvement coming in our own operating dynamics. We've also put in a lot of cost control. Whatever we had invested for a growth cycle is now done. So we have no more massive capex plans in place. Manpower is already in place. So we already see an increase in our sales, which will optimize these costs, and a better EBITDA will be seen going forth. We're looking at a 15 to 18% growth year on year.
I'm just going to take off on the comment that you made right now. You're saying that your overall volume growth is going to help boost your EBITDA margins as well. Very encouraging comment. Put some numbers to it. What are you targeting?
Well, in our business, I think by 2018 March, if I get to 18, 19.5% EBITDA, I should be very happy. By the end of the year, 17.5%, I would be very happy. But we really have to focus on our costs. These last 4 months are extremely important for us.
If you look at the CV demand, it's been gradually increasing in the last 3-4 months. Do you think that it will continue to see an uptick, the overall CV demand?
Yeah, the schedules that have come our way are very encouraging. We're not seeing a robust growth. We are seeing a dynamic growth coming forth. All Eicher Motors, Tata Motors, Ashok Leyland, Bharat Benz, they've all thrown forth very high growth numbers month on month. We've seen a sudden increase, and 1 month suddenly the schedules go up by 40 to 50%. And so we are gearing up our tier 2 line as well in terms to meet the increased demand. So, and I think this is going to be sustained, because I think the last 10 months slowdown and the industry not taking off for the last 2-3 years, now is the time for the industry to take off. So we feel that now the next 4 years are here for growth.
Just talk to us about the pricing as well. What happens generally is that in the initial phase of volume pickup, you tend to see discounts, waiting periods are not that high. Do you expect CVs to increase prices, which in turn means that you could also increase some of your component prices or pass on some of the realization hikes so that you can achieve the margins that you were just talking about?
So for us, we've always worked in a very cooperative manner with the OEMs. Normally the price increases or reductions are given with a time-bound effect. And at the OEM, we've never really had issues on the payment cycle, because within 30 days or again some kind of a discount, we get our payments in place. OES follows the same strategy, the OE spares. Therefore, pricing is not seen as an issue. We get the throughput on the material costs. What we need to ensure is the overheads are something that we take care of, and that's something that's totally in our hand. So on the pricing side, we are very competitive. Aftermarket is where we get the increased margins. International businesses, again, where we get an even higher increased margin on the local independent aftermarket. But the payment cycles in the aftermarket and international business, of course, are much longer. So that kind of offsets what the OEMs give us. They give us a lower margin, but they give us on-time payment. So it's about just ensuring that the balance is maintained at any given time.
Thank you so much for taking out time for us. Good to get perspective from you. Setco Auto has been one of the buzzing stocks since the time the CV numbers have started to go up. Of course, they supply to them, so indirectly you do get a benefit over there. On that note, completely out of time, we have to take a break. We are coming back in 2 minutes, but lots more lined up on the other side. We'll get you some special perspective as to what happened back in 2017, which HNI made a lot of money, or which stocks did particularly well, which are a part of the top HNI portfolio.